Today's session is accounting and cost. Those who have the textbook, please mention the page number in the chat box. Accounting and cost in your Six Sigma textbook. So what is the definition of the cost? Any amount that has to be paid or something that has to be given up to get something in return. Okay, that is a cost. In business, usually money is considered as a valuation of cost mostly. Okay, when you ask what is the cost of it, usually we give answer in rupees or in any money valuation. Okay, majorly money is the most frequently used determinant of cost, but apart from money there are other costs also. Okay, the cost of effort, materials, resources, time is also a cost, utilities used, risk that you have taken, risk is also a cost, opportunity that you let go, okay, in while in the process of selection. So opportunity that you have let gone in production, okay, or delivery of good or service, that is also a cost. So these are the different types of cost. Okay, different types of cost apart from money. Money is the most commonly um, used mode of valuation of what is cost. So what is cost? You have to pay something in terms of money, or you have to give up something to get something. So whatever you have given up or whatever you have paid, that is the cost. So there are three different types of cost in finance. One is the accounting cost, economic cost, opportunity cost. These are three different types of cost. Each one of this we will discuss in detail. Accounting cost. Page number is 25 onwards, those who have the textbook. Accounting costs are the actual or outlay cost that point out the amount of expenditure that has already been incurred. Okay. For example, if you're setting up a clinic, just imagine you want to set up a clinic. You have leased out a property. Okay. So the money of you have spent in lease, the lease amount is the accounting cost. Okay. You have given that money. Okay. The rent that you have paid, the money that you have paid in doing some renovation, interior designing of the clinic. These are accounting cost, expenditure that has taken place already. Brokerage charges you must have given to a property dealer. Okay, these are the cost expenditure that has already been incurred, but still now you have not started making any profit, or you have not started making any revenue, but still some cost have has already been incurred. Okay, on a particular process or on production, such as accounting cost, facilitate that for managing the taxation need and profitability of the firm. Okay, how much profitable you are, you have to go back and check your accounting cost. If the profit that you have made has covered even the accounting cost, you can say your firm is in a profitable situation. Okay, so expenditures that take place that come under accounting cost. So different types of costs: direct, indirect, fixed, variable. Direct costs are for items that directly reach your customers. Okay. So when you're purchasing some raw material, okay, to give it to the customer, or purchasing something from the wholesale, okay, to give to add some more money into it and give it to your customer, okay, so that is direct cost. An example, discount that you give on purchase, okay, customers will ask for some discount. The discount that you are giving, that is also a cost. Transportation expenses for your staff or raw materials or resources, the money that you have spent on transportation to make things available for your customers, okay, that is also a direct cost. Wages, the salary you give, okay, salary you give to your uh, wages, or that you give to the daily wage workers, blue collar workers, okay, that is a direct cost. Purchasing expenses, anything that you have to buy for your institution. If it is a hotel industry, vegetables, fruits, groceries that you buy to run a hostel or to run a hotel, okay, that's a direct cost. Okay, these are the examples of direct cost which are directly a part of the production. These direct cost is directly associated with your production, manufacturing, or services. Okay, because when you process the things that you have purchased from this, you will sell it to your customer. Okay, that is direct cost. Indirect cost, like the rent that you pay for your property, okay, the salaries that you give on a or on a monthly basis to people who work for you, okay, that is not affecting the customers. Okay, the salary that you give is to make sure that nobody leaves your institution. It has no relation with the customers. Okay, salary that you give to your employees does not affect the customers, but still it is a cost to you. Insurance that you take for your organization, for the physical structure, okay, insurance against any losses, fire insurance, okay, all these insurance that you leave that you take has no direct relation with the customers, but still for the well-being of your organization you have to take it. Okay, electricity bill that you pay, advertisement bill that you pay, okay, marketing bill that you pay, so promotion or any promotion bills that you pay, it's indirect cost, okay, not direct cost. It does not affect your customers at all. Okay, any discount that you get or any high price that you have paid here does not affect your customers at all, so that is indirect cost. Then you have fixed cost. Fixed cost is for advertisement. Monthly you have to pay something to the marketing team, or for at the or any which ways of advertisement you have used, either through mass media, newspapers, television, uh, online, okay, Instagram, any promotional uh, expense that you have to incur is a fixed cost. It usually doesn't changes. Every month you have to pay the same amount. Insurance that you take, okay, premium remains the same. Premium won't change. Usually, if you have chosen a specific kind of an insurance, the premium won't change frequently. And then stall rent for a specific period, for a one, at least for 1 year, rent won't change. Okay, every month you have to give different rent. That's not the system of rent. Rent amount will be fixed, and that fixed amount you have to pay every month for a certain period of time. Then deposit that you have given for your organization or your property, that is also fixed. Once the lease period is done, the deposit you will get back. Okay, then you have variable duties that you do. Variable cost is something that keeps on changing every time. Every at a regular interval you have to pay this cost, but it's the amount is not always the same. Okay, at a regular, every on a monthly basis or a weekly basis, you have to give this money. You have to pay this cost, but the amount is not same. That is the reason why it is variable. So duties that you get on sales, that is variable. Sometimes you sell low, sell more. Okay, so duties changes. Tax on income, that is also changing, because incomable tax and everything is usually changing every year. Labor charges, labor charges also based on the trade union's demand, it keeps on changing. And any other expenses, sudden expenses, miscellaneous expenses that take place on a daily basis. Okay, operational expenses that you will have on a daily basis, it's not same. Okay, day-to-day expenses are always different. So that's about different types of cost. Then you have operating cost. Operating cost is the money that you require to run your institution on a day-to-day basis. Okay, even you have the capital investment, budget, everything in place, but to run an organization, you need petty cash. Okay, every department will require petty cash for any some small trivial emergencies. Immediately, you don't have to go and ask for the go and ask the financial manager or the accounts department for some petty cash. Instead of that, every department will have its own petty cash limit. So that is the operating cost. So what all it covers? Traveling expenses from any department if a staff is going somewhere. Okay, if the staff is going for some uh, camp, etc. Okay, traveling expense will be there. So for that, telephone and internet expenses is also operational costs. On a regular basis, you have to make sure the internet is working. Has it finished off its GB? That you have to check. For office supplies as well, things that you require to run the hospital, like paper, pen, any forms. Okay, these things that you get from the stationery shops, you have to buy it. Legal expenses, PR team expenses, keeps on changing. These are the different types of operating cost. Then you have economic cost. It includes both accounting cost and opportunity cost. Both are called economic cost. So explicit cost and implicit cost. Opportunity cost is implicit cost. Accounting cost is explicit cost. Okay. And both of them are part of economic cost. To run an institution, you have to spend money. Okay. You have to grab an opportunity. For all these purposes, cost will be there. That is the economic cost. This runs the economy. Okay, there should be a drive and pull, and towards that pull, the or what the requirements of manufacturing should move towards. Now coming to opportunity cost. What is an opportunity cost? The cost that you incur while missing an opportunity. Okay, so here you will be making a choice. You can only go with one way. So the cost of leaving the other choice, the cost of not picking up the other choice becomes your opportunity cost. The difference becomes your opportunity cost. So, for example, you have ₹100 to spend or $100 to spend. You have two choices, either to spend the money on shoes, okay, spend the entire $100 on shoes, or you have the second option. You can invest that $100, okay, investing $100 or spending it on shoes. When you spend it on shoes, you have the utility value. At least you will wear it, use it. Okay, people can see where you have spent your money. When it comes to gold or other jewelries, okay, or like where people can actually see how much you have spent. But when you are investing that 100 rupees or $100, nobody can see it. Okay. But you know the perception of that if you're investing, you will get something more in return. You are investing your money at 5%, 10%, whatever percent. Okay. 100 plus that percent you will get back in return. Okay. So what was the difference between these two? In both cases, you are spending 100 rupees. 100 rupees is taken away from you either in form of investment or in form of shoes. Okay, shoes at least you can wear it, utility value will be there. Okay, investment, you will get something in return in terms of the investment percentage. Okay, so what is the opportunity cost here? The difference between these two, the what returns these two will give. So the difference is that $5, because in investment will give you back more. Okay, and that here according to this example it's $5. The five is the difference between both the choices, so opportunity cost is 5. So how are opportunity cost used? It is best used in new products, replacing new equipments, pay dividends. Okay, should we get a new product or not? You have a choice, yes or no. Okay, so making a sound decision in getting new products, or should you replace an equipment, or should you just do the preventive maintenance? Okay, so again, choice is there, replacing the equipment or preventive maintenance. The money that it will cost in both this scenario, the difference in that money is the opportunity cost. Pay dividends, and it helps you to use your money and time wisely. And this is what I was explaining. You have two choices, let's say, alternative that you have not chose, the alternative that you have chose. In both, there are different values. One is 40,000, one is 35,000. What is the opportunity cost? The difference between these two. Okay, the difference between these two opportunities, that is 5,000. 5,000 is the opportunity cost. Return on investment. From the name itself, you know, you are investing a money, how much you will get back. That is return on investment. So you have to find the net profit here. How do you find the net profit? Whatever revenue you have collected from your patients at the end of the day, whatever revenue, whatever money you have made, minus the expenses. Okay, so whatever remains back is your revenue. So net profit, first you have to calculate the net profit. For calculating the net profit, revenue minus expenses, you will get the net profit. The net profit divided by how much money you have invested. Okay, capital investment or cost of investment, that is the denominator. Multiplied by 100, you will get how much money you should be making by the end of the financial year. Profit center and cost center. So profit center, doctors bring patients, doctors are a profit center. Any unit in the hospital, any department in the hospital that can generate its own revenue is called profit center. So doctors generate their own revenue, surgeons make good revenue for the hospital, marketing team also gets good revenue, good tie-ups with insurance company, and they improve the patient flow in the hospital, so they are also getting good revenue. So these are all the profit centers of a hospital. Okay, any laboratories, radiography department, these are the other name. Okay, they make profit, they have their own billing, and that bill will be added to the patient's final bill. Okay, ICU is a profit center, operation theater is a profit center. Cost center, those departments which do not generate their own revenue, but they work side by side with the profit centers. So HR department, human resource department, administration department, nursing department, research and development department. So they don't have their own billing system as such, but they are directly related to the profit the hospital the venue is making. So cost centers are usually the revenue center and cost center. Investment center is at the top tier where you do the capital investment, highest level of management. Then profit centers are the middle managers, and cost centers or revenue centers are the operational managers. From revenue, you will collect the money minus the cost, you will get the profit. So comparison between cost and profit. So a department wise, meaning wise, cost center, direct or indirect costs are charged to this department. Profit center, they make profit or revenue for the hospital. Objective is in cost center to control the cost as much as possible and reduce the cost. So automatically you become profitable. And in profit center, ascertaining the exact profit, was search analyzing how much exact profit you made and try to maximize it. And by deducing the actual cost from the standard cost, you get the cost center. And by reducing actual cost from the budgeted cost, you get the profit center. Okay, budget is there for majorly the, but when you prepare the budget, the profit centers make the most of the budget for the hospital. And cost center, the work, the role is less challenging, but cost center, the role is more challenging. So that's all about different cost. If you have any queries, you can mention in the chat box.